Okay, so you want to own Tesla stock. Good news, it's one of the most traded stocks on the planet, and as of mid-2026, the company sits at a market capitalization of roughly $1.5 trillion, making it one of the 10 most valuable companies in the world. You can buy a share of it in seconds from your phone for around $400. It sounds like the safest bet in the market. The most recognizable EV brand on earth, a founder more famous than most world leaders, and a stock that has made early investors extraordinarily rich. It is not a safe bet. In 2025, Tesla posted its first annual revenue decline in company history. The stock trades at a price-to-earnings ratio north of 300, at a moment when the company's core business, selling cars, is shrinking. By the end of this video, you will understand why a stock trading at over 300 times its earnings can still be considered fairly priced by some of the smartest money on Wall Street. And you will understand the one number buried inside Tesla's valuation that has almost nothing to do with how many cars it actually sells. Let's start with what that PE ratio actually means. A price-to-earnings ratio tells you how many dollars an investor is paying today for $1 of a company's annual profit. The average company on the S&P 500 trades at around 20 to 25 times earnings. Tesla, depending on the week you check, trades somewhere between 300 and nearly 400 times earnings. Translate that into real terms. If you bought $1 of Tesla's annual profit at that multiple, you would be paying roughly $350 for it. At a normal company earning steady profit, it would take over 3 centuries for that $1 of annual earnings to pay you back your purchase price, assuming profits never grew at all. Nobody buying Tesla stock is doing that math and expecting to get their money back from car sales alone. They are betting on something else entirely. Here's the reframe that explains almost everything about how this stock is priced. You are not buying a car company. You are buying a bet on an artificial intelligence and robotics company that happens to sell cars today to fund what it wants to become tomorrow. That reframe matters because the car business, the part that generates almost all of Tesla's actual revenue right now, is under real pressure. In 2025, Tesla's total revenue fell to just under $95 billion, down 3% from the year before. That doesn't sound dramatic until you realize it was the first time in the company's history that annual revenue had ever gone down. Automotive gross margin, the percentage of each car sale that Tesla actually keeps as profit before overhead, slipped from 18.4% to 17.8% that same year, as competition intensified and price cuts ate into what the company earns per vehicle. The competition is the part most American investors underestimate. A Chinese automaker, called BYD, outsold Tesla in pure electric vehicles in 2025, moving more than 2.2 million battery electric cars to Tesla's 1.6 million. Tesla's share of the US electric vehicle market fell from roughly 75% at the start of 2022 to around 45% by early 2026. In Europe, Tesla posted monthly sales declines for months in a row through 2025. This is not a company effortlessly dominating its own category anymore. It is a company defending market share against competitors who are willing to sell electric cars at a loss to win customers. But that's only half the story, because Tesla did something in the first quarter of 2026 that surprised a lot of analysts. Revenue jumped 16% year over year, automotive margins started recovering, and Tesla reclaimed the global lead in battery electric vehicle deliveries as BYD's own sales unexpectedly slowed. This is where the stock becomes genuinely difficult to read. Is the 2025 decline a temporary stumble in an otherwise dominant company, or the first sign of a mature auto business running into the same gravity every car company eventually faces? This is where the second, hidden part of Tesla's valuation comes in. Wall Street analysts frequently describe a large portion of Tesla's market value, sometimes estimated at several $100 billion, as a premium that has nothing to do with car sales at all. It is priced in based on 2 bets. The first is full self-driving software, which Tesla says has now accumulated more than 8 billion miles of real-world driving data, a dataset a new competitor cannot simply buy or replicate. The second is the Robotaxi business, currently operating in a handful of US metro areas, which Tesla and its supporters believe could eventually generate high-margin subscription revenue that looks nothing like the thin margins of selling a physical car. If that bet plays out, the current valuation may look, in hindsight, almost reasonable. If it doesn't, if full autonomy takes longer than promised, or regulators slow down deployment, or the technology simply doesn't scale the way the company projects, then investors are holding a car company priced like a software company and the math stops working. This is the third risk, and it's the longest-term one. Tesla does not pay a dividend. It has never paid one, and there is no indication it plans to. That means the only way an investor makes money on this stock is if someone else, in the future, is willing to pay more for it than you did. There is no cash flow coming back to you while you wait. The stock's beta, a measure of how much more volatile it is than the broader market, sits around 1.8, meaning Tesla shares tend to swing significantly harder in both directions than the S&P 500 as a whole. Over the past year alone, the stock has traded as low as roughly $298 and as high as nearly $499. That is not the trading range of a stable, mature company. It is the trading range of a stock the market still can't agree on how to value. Owning Tesla stock, then, is really owning two completely different investments layered on top of each other. One is a global automaker facing declining margins, brutal Chinese competition, and a market share that has been cut nearly in half in 4 years. The other is a bet on autonomous driving and robotics that, if it works, could justify a valuation that looks absurd by every traditional measure today. The company's own numbers don't resolve which of those two businesses you're actually buying into. The 2025 revenue decline was real. So was the 2026 recovery. The 8 billion miles of driving data are real. So is the fact that full autonomy has been roughly 2 years away for the better part of a decade. Whether that bet pays off is not something this video, or any spreadsheet, can answer for you. Every number in Tesla's valuation today assumes a future that hasn't happened yet. Whether you believe that future arrives on schedule is, as always, the only bet that actually matters here.